Are you a gambler or investor? Hey friends, welcome to the Build Young Grow Wealthy channel. My name is Walida Cherie and I help millennials to control, protect, and grow their income to one day obtain financial freedom. In this video, I'm going to give you 5 tips to help you to get started with investing your money. So go ahead, get your pen and paper, and let's get into this. The first thing you'll need to do is you need to come up with some objectives. How do you plan on investing your money? Do you want to do short-term or long-term investment? So short-term would be, for instance, if you are just getting married and you and your significant other want to buy a house within the next 1 to 5 years. That would be considered a short-term investment. So you're not expecting to get money back right away, but you are planning to get that money back within a year to 5 years from now. Or do you need more of a long-term investment strategy? So you don't need the money anytime soon, but you will need that money sometime in the future, such as, say, your parents and you just had a brand new baby and you want to put money aside for college. That's going to take you another 18 to 21 years. So maybe you need to find an investment strategy that can help grow your money to the amount you'll need over that time period. So those are just a few examples. Now, I know some of you guys are listening and you're like, okay, I don't want to have kids and I don't want to get married. You don't have to, because what you also need to take into consideration is you can use your money however you want. So maybe you want to use your money for retirement. Maybe you work a job, but when you look at how much you're going to have in retirement, you realize you won't have enough money. So you can make a strategy so that you can start putting money aside today and it can grow with compound interest. So by the time you retire, you'll have enough money in the bank to live however lavishly you want to live. Then you also can use the money for things like charitable causes. Maybe you have a charity that you would like to put more money into, but at the current moment you don't have as much money as you would like to put into it. What you can do is you can start putting money in today and then think about how much time it will take the money to grow for however much money you would like to donate, and then you can give it that way. So the first thing first, you need to have a clear objective of how you would like to invest your money. Would you like a short term or would you like a long term strategy? Now, the second thing that you want to have, this is tip number 2, is you want to consider, do you want to invest your money in high risk or low risk investments? High risk investments, let's just use stocks for an example here. So stocks would be you put your money in, and the reason it's high risk is because you can't predict the market. I don't care how many times you hear people say they can predict it. You truly can't predict the market. So when you put money in, you risk either losing some or all of your money. But you also risk that if the market goes up, that you're going to get a very high return. Well, low risk investments such as bonds, you can put your money in, and if the market goes down, meaning your chances of losing money, you risk losing just a little bit of money or probably no money at all. Whereas if the market goes up, you may not get that much investments in return because it's considered low risk. So all in all, high risk, you get higher gains, but you also can risk losing some or all of your money. And low risk, you can lose just a little bit of your money, but you also won't gain a lot of money. So my rule of thumb is the older you are, the more you should consider the lower risk investments, and the younger you are, the more you should consider the higher risk investments. And I'll give you more on how to determine those ratios, so keep watching the video. Tip number 3, do you want to be an active or do you want to be a passive investor? Let me give you the definition for the two. If you want to be an active investor, that means that you want to be involved. You want to be the person who's watching the charts to see which way the market is moving. You can also pay somebody to watch that for you, and just know it's going to cost you a little bit more money because they're not doing this for volunteer work. They're actually getting paid to watch your charts to see which way the market is going, whether they should buy or whether they should sell for you. Whereas a passive investor is a person who you don't really need to be involved. You're not trading time to see how much your money is going to grow. So a passive investor would be a person who's doing something like an index fund. It also can be a person who does real estate investments. So you don't really have to monitor every single second of the day to see how your money is working. And so it just depends on how you want to be. Do you want to be hands-on, or hands off. And no matter which strategy you choose, make sure you always do your due diligence and you do further research. Tip number 4, never invest your money into something that you don't fully understand. So I know right now you're watching this video and you're getting the bare basics. So I guess you could say this is a good start. But what I mean by that is that if somebody calls you today and say, hey, jump on this, if you have no knowledge about whether it's high risk or low risk, whether you're going to get short-term or long-term gains, etc., I would not suggest just dumping your money into that. You should have at least a basic knowledge and understanding of whatever it is that you invest in. Tip number 5, consider creating a portfolio and try to diversify your money. So there's different ways you can diversify, and it all depends on your situation. This is not a one-size-fits-all. And you want to talk to a professional who's going to be able to better understand your situation to determine which strategy is best for you. But to give you a little starter, my suggestion is take these 3 considerations into diversifying your portfolio. So, number 1, do you want to be a conservative person who diversifies? What I mean by conservative, this approach means you're going to do 40-60. So you're going to take 40% of your income or your investment income, and you want to put that in a high risk investment. And you want to take 60% of your investment income and you want to put that in low risk investments. So this would be ideal for somebody who's closer to the retirement age, who wants to still grow their money, but you're just not at an age where you can feel comfortable putting that much money on the line to risk. So if you put 40%, you still have a chance on getting some high gains, but you also have your money in the 60% in the lower investment strategies. So then that way, if the market were to crash, you don't lose too much money. The second type is a person who's doing like moderate investments. So with moderate investments, you want to do 60-40. So you're going to flip those numbers. So this is a person who's probably about middle age, where you can take 60% of your money that you invest in, and you will put that money inside of a high risk investment. And then you'll take the other 40% and you'll put that into a low risk investment. So if you're in the middle age, so you're not too old or not too young, this would be an ideal ratio for you. Again, 60% in high risk and 40% in low risk. And then the last type is the aggressive diversification method. Now with the aggressive, this is better for people who are in their younger years. So usually people who are under 35, this would be a great strategy for you because you still have plenty of time left in your working years. So what the ideal ratio would be for you is you put 80% of your money in the higher risk investment and you put 20% in the lower risk investment. And the reason is because hypothetically, if you have your money into the market, right? And say the market crashes and you lose it, let's just say worst case scenario, you lose all of your money. Well, you still have about 30 to 40 years left in your working years to be able to recover from that money, either through work and accumulation through income that way, or through compound interest. So that's why the younger you are, taking an aggressive approach can be very beneficial for you. Whereas if you're older, say you're 60 years old and you plan on retiring at 65, you wouldn't have compound interest on your side and you wouldn't have working years left on your side. So it just wouldn't be a good strategy. But again, talk to a professional to find out which strategy is best suitable for your needs. But those are just the ones out there that I think are the most common ones that I think people should consider. Now I have a bonus for you. Don't invest your money into any trends. Again, going back to my previous tip when I said you need to educate yourself, don't invest your money into a trend. And the reason is because I'm pretty sure you've been approached by family and friends who suggest that you put your money to something to get rich quick. And 9 times out of 10, they're probably still not in that same investment strategy that they were trying to get you to do. So I don't want to make any type of claims, but I have been approached by a lot of people for a lot of different things. So I don't want to just single one out, but you know which ones those are. I bet if you had somebody 6 months ago to ask you to put in $500 or $1,000 or any type of amounts, I almost can bet you that they're not still doing those same things themselves. And that's because typically those are very short-lived. And the reason why I also don't want you to jump on those trends outside of you not being educated, is because you want to make sure it's legal. Sometimes doing those different things that people say that you should do, they're probably not legal. And if they're all are legal, they need to tell you more things such as how much is capital gains tax? How much are the fees that are involved for people to manage your money if it's a active investment, or even if it's a passive investment, what are those fees going to be? And also, what's the legality? So that means, is it a contract? Are you going to actually get that money that they say that you're going to get? Because sometimes you can give money to people and then they can ghost you and you'll never see that money again. So those are my 5 tips to help you to get started with investments. If you found any value in this video, I would love it if you could like it and then share it with a friend. And if you like more content like this, consider subscribing for more great content, because every week I'm going to put out a new video, and it's going to be to either help you to control, protect, or grow your income. Until then, thank you so much for tuning in, and I'll talk to you guys later.